If you are confused with smart money concepts and everything seems overwhelming to you on the internet, then this is going to be the perfect video for you. My name is Nick and I've consistently made hundreds of thousands of dollars monthly trading with smart money concepts in front of an audience of thousands daily. And in this video, I'm going to be breaking down everything you need to know from head to toe about smart money concepts and what actually makes money with these concepts. I'm so sick and tired of the overload of misinformation on these concepts. So I'm going to break down everything you need to know in order to become profitable. Orderblocks. Orderblocks are one of the most commonly thrown around terms in the institutional trading space, but they are also misunderstood by many. And that's why I'm making this video. Now, by the end of this video, you will understand the following. What are order blocks? How to identify order blocks? Order blocks validity? And finally, a strategy involving order blocks which you can use to trade like the banks. Now, let's stop wasting time and let's get right into it. First off, what are order blocks? An order block forms when there is a manipulation in price created by the banks. Let me explain. Let's say, for example, for gold. Gold is at $2,000 and Bank A wants to buy gold. But does it make sense for Bank A to buy gold at the current market price, given that they got billions of dollars to move the market? No. So, the next most logical thing for them to do in order to profit more is to manipulate the price. So what they do here is they artificially cause a sell-off by putting a small sell position on gold, causing price of gold to dump. And as price dumps to, let's say, 1995, a $5 discount, a lot of retail traders, which includes both you and I, tend to FOMO into the sells and therefore causing price to push even lower to, let's say, 1993. And at 1993 price point, this is where the banks can decide, look, I'm at a $7 discount from the initial market price. It is a great time to buy and start loading up on my buys right now. This is where they put extremely big buy orders at 1993, resulting in price pumping all the way up to 2010, for example. This is the power banks and institutions have. They can manipulate the market to get them the best positions possible. Now, this point of the manipulation where it started to where it ended is where the order block is formed. Okay, let me repeat that one more time. The point of manipulation from where it started to where it ended is where the order block is formed, as seen over here. Now, one more thing to note is that order blocks is also part of the PD array matrix. Now, what is PD array? Premium and discount array. Premium refers to when price is very high and it is at a premium price and therefore we are more than likely to sell off. Discount, on the other hand, is where price is extremely low, extremely cheap, and this is where the smart money tends to look to buy at a discount. So essentially what you want to do here is to become a buyer at discounted prices and a seller at premium prices. Now let me give you an analogy. Let's say I bought a stock at an average price of $100 and right now price went up all the way to, let's say, $150. This is where we are at a premium pricing. Price is already 50% from its original pricing. So that means the price is way higher than it should be. And any normal human being would actually take profit and sell the stock in this premium range. On the other hand, what you will most probably see the stock as is a discounted price, a very cheap, undervalued stock for you to buy. And therefore, most people will most probably buy. So, to identify a premium and discount array, you need to draw a Fibonacci retracement tool. This tool can be found on TradingView on the left panel of your screen, where there are your tools available for you to use to mark out your charts. What you want to do here is click on the third icon and you should be able to spot your Fibonacci retracement tool. Now, when you draw your Fibonacci retracement tool on your chart, what you want to do here is draw it from the swing low to the swing high like this in an uptrend, or a swing high to the swing low in a downtrend. The 50% over here is your equilibrium. Any point of interest above the 50% level over here is your premium array where you will look to sell from. This is where you'll find your bearish order block, bearish fair value gap, bearish breaker block, etc. Likewise, any point of interest below the 50% is your discount array where you'll look to buy from. This is where you'll find your bullish order block, fair value gap, and breaker block, and so on. Now, if you don't understand this fully, not to worry, as I'll be going through how to use it with examples later on. Since we are talking about order blocks, our premium array would be a bearish order block because this is where we are looking to sell from. On the other hand, a discount array would be a bullish order block because we are looking to buy from the bullish order block. Now, the theory behind order blocks is that there are going to be orders inside this block or candle. Whose orders? Smart money. Think of the big financial institutions that have billions of dollars in capital. They have such large orders that they can't just simply press buy and sell whenever they want to, like we can as retail traders. Institutions need to do the exact opposite of what price is currently doing in order to get involved in the market. Now, I want you to put yourself in the shoes of someone with billions of dollars in capital. You have the ability to use these billions of dollars to buy gold at $2,000. Would you rather buy at $2,000 at one shot, or manipulate the price to bring it down to 1993 before buying the dip for even more gains? You must understand that the market is a zero-sum game. For every buyer, there needs to be a seller, and vice versa. If institutions are trying to buy gold, they use a small position to cause a sell-off on gold. Now, when the fearful retail traders see this sell-off, they think, oh, it's time for me to sell now so I can profit. And this is when the retail money comes into sells, which pushes price even lower, allowing the real massive buy positions from the banks to be filled from these unexpected sellers. The result is that the banks will get extremely cheap prices because they manipulate traders, and the retail traders get stopped up because they don't understand how things actually work. So in this specific example, the order block is located where the banks start to manipulate price lower, all the way down to the lowest point in price came to before aggressively pushing higher. This is the bullish order block over here. Now, let's get into how we can actually spot an order block. Some things here may be actually a little bit confusing, so pay close attention. So, if we know institutions are buying in bearish candles and selling in bullish candles, then those specific bearish and bullish candles will be your bullish and bearish order blocks, respectively, as seen over here. Now, of course, not every single bullish and bearish candle is an order block. So we need to have a criteria to see what is valid and what isn't valid. So let's go ahead and go through my personal checklist of criteria that a valid order block needs to have. If we are looking for a bullish order block, we want to see a bearish candle that fits the following criteria. Criteria number 1. A bullish order block needs to come off a support. If you're a complete beginner, a support is an area price is failing to break below a certain price level many different times, showing that there is a lot of retail traders buying at that specific price level. Criteria 2. The candles following the potential order block needs to break the high of the bearish candle with a bullish engulfing candle. A bullish engulfing candle is a candlestick pattern that is bigger than the bearish candle that was created prior. It is important to note that the body candle close of the bullish candle must be above the high of the bearish candle as seen over here. This indicates that the buyers are stronger than the sellers in the market, giving us confirmation that there is enough bullish volume for price to continue pushing higher. Criteria 3. The impulse move must create a bullish fair value gap that overlaps with the order block. Right now, you may not know what a fair value gap is. So to quickly recap, a fair value gap is a 3 candlestick pattern as seen over here. It is the gap between the first and the third candle's wicks with a big body candle in the middle. Fair value gaps are a key indication of the market providing high bullish or bearish volume as seen over here and over here. Without getting too deep into it, orders will be left behind when price is pushing aggressively. When price comes back down to fill these orders, it refuels the bullish or bearish trend, pushing it aggressively in its intended direction. If you're confused, I did a whole video about liquidity last week where I explained fair value gaps. You can take a look, but for the purpose of this video, the key takeaway is identifying fair value gaps, not understanding 100% of what a fair value gap is. Trust me, you'll see later. So these 3 criteria create a valid bullish order block. If price returns to the order block, we can start to look for longs. A bonus tip before we move on to the next section. An order block does not have to be one singular candle. If there are multiple consecutive down candles like this, or multiple consecutive up candles like this, these are just one big order block. Now, let's take a look at some examples of valid and invalid bullish order blocks. For this first example, let's use the checklist from the previous section. Number 1. Is this bearish candle coming off a previous support area? Yes. The candle is over here and the support area is over here. This area is a support area because the price has rejected 3 times before, pushing higher with aggression. Number 2, do we have a bullish engulfing candle that breaks the high of the bearish candle? Yes, this is the structure that we're looking for as seen over here. Number 3, do we have a bullish fair value gap overlapping with the order block? The answer is yes. As you can see, these 3 candles created a gap between the first and the third candle's wick, and therefore this gap is a bullish fair value gap. So with this being a valid order block, you can look for longs here, and you can see that the order block is respected and it holds up nicely, pushing price even higher. Let's move on to the next example, again using the same checklist. Number 1, do we see a bearish candle coming off previous support? Yes, as you can see here, we have many different wicks rejecting off this area here. Hence, it is a support level. Number 2, do we have a bullish engulfing candle that breaks the high of the bearish candles? Yes, we had a body candle close above these 3 candles as seen over here. 3, do we have a bullish fair value gap overlapping with the order block? No. Price did not create a gap over here, as the wicks are touching each other in this 3 candlestick pattern. Therefore, this is not a valid order block. As you can see, price completely disrespects the order block and started to plummet lower. Now, all you got to do is to follow these 3 criteria to the T. Don't try to act smart and think that if one of the criteria are lacking, you can still take it as a low probability order block. You're just gonna end up taking low probability trades resulting in losses. So stick to the plan and execute flawlessly. Alright, so we have covered the bullish order blocks. Let's move on to the bearish order blocks. Bearish order blocks are bullish candles coming off previous resistance, followed by an impulse move that breaks the low of the bullish candles with a bearish fair value gap overlapping with it. I know, it may sound like a mouthful, but let me show you an example. So right here, we have an example of a valid bearish order block. We come off a previous resistance area, which is seen over here, using the double top, followed by an impulsive move that breaks the low of the bullish candles, overlapping with a bullish fair value gap, as seen over here. At this point, you may be asking, aren't the next few candles also a valid bearish order block? In that case, you will be right, because all 3 criteria are also met. Another common question that you may have is, when do I mark out the order block candle bodies and when do I mark out the wicks? Very simple. Use whichever is overlapping with the fair value gap. If both the wick and the body are overlapping each other inside the fair value gap, then use the wicks. Oh, and one more thing. Order blocks only have a one-time use. Do not reuse them again. This is because once the order blocks have been retested, the orders sitting inside the order blocks will have already been collected and hence will not be as effective if price action comes back and tests it again. So we have gone over what order blocks are and how to spot valid order blocks. Bullish order blocks are just bearish candles and bearish order blocks are just bullish candles. But again, the context behind them and the criteria to validate them are important. And that's why not every bearish candle and not every bullish candle is an order block. The context behind them is extremely important as well. Really go ahead and take the time to train your eyes to see this every single day in the markets, as it is very important that you're developing your own edge in the markets. Me telling you these steps will not help you at all if you don't apply it consistently. You need to do the work on your own. I'm just giving you the guidelines to get you to actually get the work started. At this point, we have gone over the theories behind order blocks, how to identify them, and how to validate order blocks. Now, I will show you the strategy that I use to get results like this. Step 1. Identify market structure on the 1 hour or 4 hour time frame to determine your market trend. Just a recap for those of you guys here that are new. An uptrend is where you have higher highs and higher lows, whereas a downtrend is where you have lower highs and lower lows. A break of structure happens when you create a high high in an uptrend and a lower low in a downtrend. Whereas a change of character is a reversal pattern that occurs when there is a break of a higher low in an uptrend and a break of a lower high in a downtrend. So what you want to do for step 1 is to look out for your potential break of structures for trend continuations, and change of character for a potential trend reversal. Remember to focus on the most recent price action. Step 2. Look for a valid order block on the 1 hour or 4 hour time frame that is pro-trend or in line with the trend. If you're in a bullish market, bullish order blocks are pro-trend as you are looking to buy along with the bullish market. The opposite is true for the bearish order block in a downtrend. Now, we've already gone through the 3 criteria earlier in the video. If you're not yet familiar with it, go back and replay that portion of the video. After you've spotted your order block, we move on to the next step. Step 3. Time frame alignment. If you're using the 1 hour order block, look for your confirmations on the 5-minute time frame. If you're using the 4-hour order block, look for the 15-minute time frame for your confirmations. This time frame alignment is extremely crucial. You don't want to be jumping the gun on your confirmations. There shouldn't be too big of a jump in the time frames from your high time frame order block to your lower time frame confirmations. From my personal backtesting and experience of trading 7 years, this alignment has worked the best for me. Step 4. Wait for price to tap into the order block and look for a change of character on the lower time frame. So what I mean is you need to see price create a high high in a downtrend or a lower low in an uptrend, as this will classify as a change of character. The lower time frame change of character gives us confirmation that the higher time frame order block is being respected. Instead of waiting too long on the higher time frame, I zoom into the lower time frames to get in earlier for a sniper entry. This is exactly how I get accurate entries and get involved in the move before it's too late. Step 5. Place your stop loss above or below the order block, targeting the swing highs and lows. Now, if you're confused with the SL and TP placements, not to worry at all. Let's go through it with some live examples that I took live on the stream. This is the 4-hour chart on GBP JPY. We have just created a new all-time high. Let's go back to step 1. Identify market structure. We can see that price created a bearish change of character after creating new all-time highs as seen over here. This bearish change of character was created because it broke a 4-hour high low in an uptrend as seen over here. Therefore, we can establish a bearish market trend. Step 2. The order block. The 4-hour bearish order block right over here formed off a previous resistance area over here. As you can see, a bearish engulfing candle formed over here that broke the bullish candle low, therefore creating an overlapping fair value gap over here. The fair value gap is identified with these 3 candles over here. Now, as long as you can see a gap between the first candle and the third candle's wicks, you have a fair value gap. And in this case, it's a bearish one. Since all 3 criteria are met, this is a valid bearish order block. Step 3. Time frame alignment. We drop down to the 15-minute time frame and observe a tap into the 4-hour bearish order block. Remember, 4-hour order block, we use 15-minute time frame confirmation. If we use a 1-hour order block, we use a 5-minute confirmation. So, in this specific example, since we are using the 4-hour OB, we need to use the 15-minute confirmation. Step 4. All I did was wait for a bearish change of character on the 15-minute time frame, which was formed when the 15-minute higher low broke, indicating a bearish reversal. I then entered for a trade right here, with stop loss above the bearish order block, targeting the 4-hour swing low. If price decided to reverse and break past the bearish order block high over here, it indicates that the market wants to continue higher and therefore invalidating the trade. That's why I placed my stop loss here. This is a fact, but a lot of new people randomly place their stop losses based on gut feeling. The reason why we have specific stop loss placement is because if our stop loss gets tapped, it would mean that the entire market is looking to reverse completely, and the stop loss is the exact point in price where the initial market structure breaks, and therefore completely invalidating the trade. Now, for take profit wise, we are targeting the 4-hour swing low as we're looking to continue the bearish trend, creating lower lows. Now, let's go ahead and take a look at how the trade plays out. After a while, you can see the trade instantly smashed full TP without much drawdown. Personally, I took this trade and made a few grand off it, but optimal trading is not just taking a position and holding it all the way. Optimal trading is taking tranches of profit based on a set plan. So let me explain. In this specific scenario here, each time price breaks through a 15-minute low, I take 20% of my original position size. This is to ensure that I secure my profit in the scenario price completely reverses and stop me out at break even. Remember, the goal of trading is to put money in your pocket, not to catch the largest trade possible without proper risk management. Now let's move on to the next example. This time we are on the 4-hour chart on AUD JPY. Let's go through the steps once again. Step 1. Market structure. In the most recent leg of price, we broke structure to the upside over here. This structure break is identified when price broke above the bullish doji candle's high on the left, creating a higher high which is indicative of a bullish change of character. Therefore, I can look for buys. Step 2. Identify the valid order block. The bearish candle over here came off a support area formed by the double bottom as seen over here. Just to recap, this is a support because price has actually tapped into the area multiple different times. And each time price taps into the support, price pushes up very aggressively. Price also created a bullish engulfing candle as seen over here that closed above the previous bearish candle's high and is also overlapping with a bullish fair value gap over here. Once again, if you cannot identify the fair value gap, I'll make it clear to you now. For a bullish fair value gap, you want to see a gap in between 3 consecutive candles that is identified by the first candle's top wick and the third candle's bottom wick, which is not touching like this. With these 3 criteria met, this order block is now valid. Step 3. Time frame alignment. Again, since it's a 4-hour order block, I'll be using the 15-minute time frame for confirmations. Step 4. Wait for a change of character to the upside before taking a trade as seen over here. Just a short recap. A change of character is where you see a higher high created in a downtrend, indicating a potential reversal is about to happen. Lastly, I place my stop loss below the swing low, targeting the 4-hour swing high. For the stop loss, if price decides to break below the swing low, price will create a lower low on the 15-minute time frame, which is indicative of a bearish trend. Thus, placing my stop loss here ensures that I minimize risk in the scenario I'm wrong about my trade. Take profit wise, we are targeting the 4-hour swing high as we are expecting to continue the creation of higher highs and higher lows on the 4-hour time frame. And again, let's see how this trade plays out. Boom, like clockwork, TP smashed. There you have it. Order blocks from the top to bottom. Of course, technical concepts can only get you so far. For those of you guys here who are a long-time viewer of the channel, you will already know this. But for those who are watching us for the very first time, technical concepts are merely the tip of the iceberg. The foundations of solid trading always stems from number 1, emotional and psychological management, number 2, a solid trading plan, and of course, number 3, risk management. Nothing in trading is guaranteed. Remember that. The only thing that differentiates trading and gambling is your risk management. So right now, let's go ahead and dive into a few principles of risk management with this strategy so that you can ensure victory in the markets. Principle number 1, don't be cute, follow the trading plan. Now, a lot of you guys here are new traders and you don't understand the nuance of a trading plan and therefore you don't follow it. This results in you taking trades left, right and center without following the confirmations. Because you are rushing to trades, you are excited for a win, and you just want to see the strategy work. Now, this normally results in you taking lower probability trades and therefore you lose more. Now, when I first started trading, I had a trading plan, but I didn't follow it to the T. I didn't follow my steps. I had it written out in a journal, but I threw it all out of the window. I had concepts like support resistance, MACD, RSI, so many things like that, all the weird concepts. And my win rate dropped to 40% from 80% and therefore losing a couple of thousands of dollars in a short period of time. It was only after I reviewed my journal that I realized that not following the trading plan was actually the biggest reason why I lost the most amount of money in my 7 years of trading. So don't follow in my footsteps. Make sure to go ahead and hit this advice and follow the trading plan to the T. Principle number 2. Flipping account isn't the way. Now, the problem with the industry is that it likes to promote small account, big wins. What do I mean by that? $100 to $1,000 challenge. But The reality of trading is that for you to be sustainable long-term and profitable, for you to be able to scale your account from 3, 4, 5, 6 figures, potentially even 7 figures, is that you need to have a larger account and focus on small, consistent percentage wins. Personally, if I have an account less than $10,000, I'll be risking 3 to 5% of my account, as this will allow me to have minimally 20 trades of losing before I bust the entire account. And throughout my 7 years of trading, I've never lost 20 trades in a row. And this is why 3 to 5% is a sustainable amount to risk, especially if you have a smaller account. However, if you do have an account size of more than $10,000, I would strongly recommend you to bump that risk down to 1 to 2% per trade. This will give you enough room to be able to lose, let's say, 50 to 100 trades in a row. Now, if you ever lose that many trades in a row, you're doing something wrong with your psychology, right? You should never be losing so many trades in a row, right? Given that you have a proper, profitable trading strategy. The key idea here is that we are risk managers. We are not gamblers. And therefore, we need to risk a smaller amount and make sure that we win more consistently to be able to grow our account exponentially in the long term. One tip I have for you is that you should see trading as how much can I lose compared to how much can I actually gain from this trade. Principle number 3, overtrading. With this newfound order block concepts, trust me, you will be able to see it all over your charts, be it whether you are trading forex, crypto, the stock market, etc. Now, what you need to do here is remain disciplined and only pick the 4 and the 1 hour time frame order blocks. Do not suddenly drop to the 1 minute time frame to find trades. The reason why we say 4 hour and 1 hour order blocks is because there is less noise. Price action is cleaner on the higher time frame, and therefore you take higher probability trades. As a beginner, don't try to lower the time frame that you're trading on because you don't understand effective SL placement yet. Now, let me give you an example. Last Friday, I took a gold short that was 7 pips away from SL, but it completely reversed to massive profits. Now, this is the only reason why I'm able to do it, because I am a seasoned trader, and only seasoned traders know where effective SL placement is on the lower time frame. So, don't jump the gun. Don't go ahead and look for trades on the 1 minute time frame when you have no experience doing so. Follow the trading plan, follow the video exactly step by step, back test it, forward test it until you're comfortable, and then start to tweak it towards the lower time frame once you have your data collected. Now, since you have stayed all the way to the end of the video, I'll give you a bonus tip. Order blocks are further strengthened with a strong understanding of liquidity concepts. Things like identifying the type of liquidity, the logic behind liquidity pools and sweep, and of course, all the things that I've actually went through in my previous video, which I'll link up over here. So make sure to go ahead and take a look at that. Last but not least, remember to subscribe and turn on the bell notification to get notified when we drop our next YouTube video here. If this video has helped you out in any way, or if you like this style of video, make sure to give it a thumbs up so that we can do more of this type of videos. Nick signing off.